Hi guys, in this video, I will be sharing how I analyze and pick a dividend stocks. There are a few key metrics that I use when I choose a dividend stocks. First of all, it will be dividend yield. 2 to 3% is solid while above 4% is high. And next will be dividend payout ratio. I normally will choose a company that has the dividend payout ratio which is above 60%. This is because a small decline in earnings would leave the dividend uncovered, unless there are companies with steady cash flow and business which like real estate investment trusts. Next will be debt to equity. This will give us the idea of how leveraged the company is. With current low interest environment, it does make sense for the company to have higher debt to equity ratio. The fourth one will be interest coverage. It's a measure of how many times over their operating income can pay for their debt interest. Naturally, interest coverage cannot be too low, and the higher will be better. And the fifth one will be revenue growth. I believe that the growth in the company will reflect in the share price, which causes the share price to continue appreciate in the long run. And the sixth, which is the last one, will be the share count. If the share count is decreasing, it may be a valuation trap. Even though the company is not making more or extra money, by decreasing the share count, the earning per share will be higher, which makes them like a better company in a way. So in this video, the company that I will analyze is this company. This company has three segments, two of which are shipyards. They produce ships and non-nuclear power ships and nuclear power ships. And below is the financial highlights in 2020. They delivered a Legend class security cutter stone. Legend class cutter is the largest active patrol cutter class in America. They also awarded a $2.2 billion construction contract for 6 module sections for each of the first 2 Columbia-class submarines. You can find out more on their website. The website that I will be using to find all the key metrics is Morningstar. First of all, we will see the revenue. As you can see, from the year 2011 to 2020, the revenue is growing from around 6.5 million US dollar to around 9.3 million US dollar. It has a decent payout ratio for around 28% in the year 2020, and the number of shares is pretty consistent. Next will be the interest coverage. In the year 2020 is 8.11, which means that the operating income is managed to cover 8 times the debt interest. And the debt to equity is 0.97, which is also pretty good in this low interest rate environment. And after the stocks fit all the key metrics and the criteria, what I will do is I will calculate the intrinsic value to determine whether it is the fair price for me to buy now. And below is an example of a free and useful intrinsic value template that we can download from. In the template, you can see that there's a few things that we need to fill in. First off, the cash flow, the growth rate, and the probability. After filling the cash flow, you determine the goal rate of your own. what you expect the company will do in the next 10 years. And there will be 3 scenarios: the best case, normal case, and the worst case. Discount rate is what you expect you will get in the year. If you expect you will get 12% return, then you can put higher discount rate. Or terminal multiple is what do you expect the PE ratio of the company will be in the 10 years time. And lastly is the probability of your scenario play out. You can choose your own probability. The current market cap is 8.47 billion, which is below the intrinsic value of 9.96. Therefore, is undervalued in my opinion, with approximate 15% of margin of safety. That's all for my video. And lastly, please do your own due diligence, as it is not a financial advisor. And I will share more stocks that fits both key metrics and criteria in future video. So yeah, stay tuned and have a nice day.